All right, good afternoon, everyone. I am Councilman John Bullock, Chair of the Finance and Performance Committee. Appreciate you being with us here this afternoon. We are also joined by member of the committee, Councilmember Felicia Porter. Also staff to the committee, Marguerite Curran. We're also joined by representatives from the mayor's office as well as the council president's office. And today we are going over legislative oversight 210003 quarterly budget briefings from the Bureau of Budget Management and Research. Always glad to see you guys, and we'll definitely at this point turn it over to Bob Seneme.
Okay, thank you. My name is Bob Seneme, Deputy Finance Director, here to present our second quarter projections for fiscal 2024. Is there a way you can get the... Okay. Excellent, thank you. So today we're here to present the second quarter projection for fiscal 2024, the second quarter analysis. So this reflects data that we've analyzed on both expenditures and revenue through the end of December, through the second quarter, and it includes a projection of how we expect to end the rest of the fiscal year. So just to start, big picture first, we are projecting an $18.5 million overall general fund surplus as of the end of the second quarter. That's made up of three components, which you can see there on the screen. It's made up of a $24.5 million revenue surplus. It's made up of plus a $300,000 expenditure surplus, and then also a $6.3 million PAYGO capital deficit, which we'll explain in a moment. So the net of those three items is $18.5 million in the general fund. So we're projecting that we'll end better by $18.5 million versus what we started the fiscal year at. So if you go to the next slide, we'll start with revenues first. And so our revenue surplus is anticipated at $24.5 million. This is mostly being driven by investment earnings, which we'll talk in a little bit more detail about in a moment. We also are seeing improved highway user revenues. And we want to note here that highway user revenue doesn't come back to the general fund because we have to spend that on transportation-related projects. That ends up being redirected to higher capital projects, which is why you saw the deficit on the capital projects line. So we'll go through that in more detail in a moment. And I did want to mention one thing that's very important is this projection does not rely on fund balance to balance. So if you remember the fiscal 24 budget, we were not fully at balance on a structural basis. We budgeted for using $29.4 million of fund balance to be able to end the year in balance. And where we are now at the end of the second quarter, our revenue has improved enough that we believe we will not need to use that fund balance. That's a really good sign. Again, most of that is driven by the fact that our investment earnings are much stronger than projected, which we'll explain in a moment. But that's a good signal because that means we're kind of back in structural balance for what it's worth. And then if we can end the year with this type of picture. So looking at the revenue in a little bit more detail, you can see these are the categories of revenues on the left. On the far right, you can see the surplus and deficit in each of those categories. And so the first couple lines, local taxes, state collected taxes, you can see there's some small surpluses there. You see a $30.1 million surplus under that category called use of money and property. That's the investment earnings that we'll talk about momentarily. And then at the bottom, you can see prior year fund balance. We had budgeted for using $29.4 million. We're actually projecting that we don't need any of it, which is a deficit of 29.4. And the net of all those is where we're getting that $24.5 million revenue surplus. So moving to the next slide, this is just visually the sources, the revenue items where we have either large surpluses or large deficits. We'll go through these left to right individually. So you can see investment earnings, again, is the biggest. Some surpluses in income tax, highway user revenue, and charges for central city services, and then deficits in our cable franchise fee, recordation and transfer taxes, and real property taxes. And we'll have a separate slide that we'll go over for each of these right away. So On the surplus side, so let's talk about investment earnings first. So what's happening on investment earnings is there was a period of time, about a little bit over a year, where the Federal Reserve raised interest rates rapidly. And they went from close to zero all the way up to about 5.5%. When we built our 24 budget, the Fed was in the process of raising the interest rates, and we made an assumption in the budget of where those interest rates would end up. Even after the budget was adopted, interest rates continued to grow to that about 5.5% level. So what we're seeing so far is just very simply as the market environment has gotten better for short-term investments, we're bringing in a lot more money than anticipated just by virtue of the interest rates being higher. And again, you're seeing there, our yields average about 5.4%, very close to that market rate through the first and the second quarter of fiscal 2024. The other thing that's happening here, the other dynamic that's more one time, is that we are sitting on is not the right word. We have available to us ARPA cash, and we know that's going to be spent down very quickly over the next 3 calendar years. Because we have that ARPA cash in our bank accounts, we are allowed by federal rules to invest that as part of our normal investment policy, and those returns can come back to the general fund. So that is creating some additional help in this investment earnings account. Again, that's one time. That will diminish over the course of the next 3 calendar years, and by the end of 2026, we'll have no ARPA remaining, presumably, because that's when the deadline is to spend it, and so there won't be that kind of help to investment earnings. But that is also influencing the fiscal 24 projection so far, because we have that cash available as part of our investment strategy. You can see just on the chart, I'm sorry, if you just go back real quickly, if you can see on the chart, back in 2021 and 2022, we were generating very little, just a couple $1 million a year in investment earnings. And you can see how, quickly that has grown over the last couple of years because, again, of that rise in interest rates and that ARPA funding that is available to us. So our projection is that we'll bring in $59.6 million of investment earnings in fiscal 24 alone, which is definitely the highest I've seen in my career here because of those higher rates. Next, on the surplus side, so we're also seeing a surplus in a line called charges for central city services. Basically, what this is that the general fund charges the utilities an overhead rate. The utility uses a lot of general fund services. They use our HR support, legal support. They use our finance systems, IT systems. And so they pay a 6% rate on the amount of spending that they do. And their spending is higher than what we expected in the first quarter. And so we're projecting a $5 million surplus on this line that will bring in about $19.5 million from them rather than the $14.5 that was budgeted. The higher spending is partly around some of the staffing augmentation they've been doing on the utilities, and some of the regulatory issues that they face this year, kind of staffing up to address some of those issues. So the utility spending is higher, which means we get just a higher overhead rate coming to the general fund. Next up is income taxes. So income taxes, when we came in the first quarter, we didn't have much to report because we get our first big distribution from the state in November. So as you know, the local jurisdictions piggyback off of the state returns. And what the state does is they're withholding money from folks' paychecks, and they turn around and they distribute some of that back to local jurisdictions. And so what we saw in our November distribution is that we're running about 1.5% better than what was expected in budget in terms of those withholdings and estimated payments that's redistributed back to the city. There's also other smaller returns that they'll distribute back to us, fiduciary returns and what we call unallocated withholdings. We have a projection for them. We don't think those will change. We'll learn more about those as we get further into the year. But again, our first big November distribution for income tax shows that we'll be about $6.3 million better than budget than what we budgeted for fiscal 24. And then also on the surplus side, so highway user revenues are projected at $6.3 million above budget. And what we're seeing here is that a lot of this increase is driven by some of those core things that are part of HUR that we've listed here: titling fees, registration fees, and gas taxes. The corporate income tax is also part of the HUR formula. That's coming in a little bit lower than anticipated, but overall, HUR is up by $6.3 million. Now, I want to come back to this again and explain this in more detail. So we are at a point now, because our share of highway user revenues has been growing per the state law, which I think we've explained before, that there's a schedule of our HUR percentage getting higher and higher over the next couple of fiscal years. We're now at a point where we have more HUR revenue than we do eligible operating costs. And so what the dynamic that happens here is that if we do generate surplus, that doesn't come back to the general fund. We actually have to use that on eligible transportation-related expenses. And that can be either operating costs or capital projects. And we're showing a deficit in capital projects because we're saying this 6.3 of additional HUR we're bringing in, we're going to have to turn around and spend that on additional unbudgeted capital projects. That's not a bad thing. That's a good thing. We need to do more on our transportation infrastructure. But that's why that dynamic, we show 6.3 up on the revenue side for HUR, and we're showing minus 6.3 as a deficit on the capital side, which of course nets out to zero. So this revenue here has to be spent. There are years where our operating costs might come in higher than budget, and we can charge those against HUR, but we're not planning on that, which is why we're showing it as additional capital. Next, parking transfer to the general fund. So the way the parking funds work is we generate revenue through a lot of parking related things: parking meters, parking fines, garage income, parking tax, and that flows through our parking funds. And then if there's any expenditure savings on those fund sides, the net of that all flows into the general fund. And so we're seeing a net $4 million surplus of flow through to the general fund from parking. That's made up of a $1 million deficit on the revenue side and about a $5 million surplus on the spending side. And you can see on the revenue side, we're showing deficits in metered revenue and garage income. So those are coming in a little slower than anticipated, but there is a small surplus in parking tax. And then on the spending side of the budget, we have lower than expected costs for debt service, contractual spending, and meter installation costs. And again, since that's a surplus in the parking fund, that flows through to the general fund. We're also showing a surplus in the parking management fund. That's where our TOs or STOs are budgeted, our transportation enforcement officers are budgeted, and we have vacancies from about 35 unfilled TO positions. And again, those savings flow back into the general fund. Our intent is always to fill those positions as quickly as we can, but if there are savings there, they flow through onto the revenue side of our budget. Moving to the deficit side for revenues, first up is real property taxes. So we're showing a $2.3 million deficit versus our '24 adopted budget. And there's a couple things going on here. First is our assessable base. So when we send out tax bills in July, we know exactly what the assessment is, and we're sending all of our property owners a bill for that. During the year, you can get a couple things that can happen. You can have new construction that adds more to our assessment. You can have property owners appeal certain properties and try to bring the assessment down so that they get to pay lower taxes, or you can have other kind of off-cycle adjustments. And what we're seeing so far is that there has been a decrease in our overall tax base from July through to February of $181 million. And we'll show on the next slide a little bit more detail. Most of that's coming from commercial properties that are being reassessed lower, and we'll show you some examples of the big ones there. The other thing we're factoring in here is that our real property tax rate, collection rate, has declined over the last couple of years, and that's because, if you remember, we've taken some actions each year at tax sale to try to remove certain properties from the tax sale. That's both a good thing and a bad thing. It's good in that we're protecting certain homeowners that might be vulnerable, but we are losing the ability to collect from those. And so we're showing for our projection that if we continue to do that this year, our collection rate will come down to just shy of 96%, whereas traditionally what we've budgeted is about 97.5% for our property tax rate collection. Just for reference, if we were to get up to that budgeted collection rate, that would add almost $16 million of property tax revenues and put us well above budget. On the next slide, we'll show you those commercial changes on the assessment base. And what's happening here, This is broken down by neighborhood. So in the Inner Harbor alone, there was $92.7 million of assessment losses just between July 1st of this year and now. And again, the big one that's happening there is that 100 Pratt Street, which is the T. Rowe Price building, that one is accounting for more than half of the loss there. And what we're seeing in the Inner Harbor, especially in downtown, is that some of those buildings are not filled. We know in this case that company actually moved to Harbor Point, I believe, and so that building has vacancies. So sometimes the owners can ask for an off-cycle assessment and say, hey, my building is not as valuable. Please, SDAT, reassess me and bring the value down. And that's what happened in that case. We also, in the downtown neighborhood, have additional $73 million of reduced tax base over 42 properties. And one of those properties alone, 1 South Street, accounted for $26 million of that loss. We looked at that one. Our team looked at that one. That building was the one that sold. There was some news about that a few months ago. That sold for much less than it was assessed at. So SDAT brought the assessment down to very close to the sale price. We also noticed that there's a big property in Charles Village that was written down by $50 million. That's 3200 St. Paul Street. We're not exactly sure what the dynamic was there, so we're looking into that one more further and can report back as we learn more. But the point here we want to make is that, we've been saying in our other budget hearings, fiscal 26, when we reassess Group 1, which is the downtown, we are at risk at losing more value, commercial value especially, because of the struggles we've had in downtown, loss of businesses and vacancies and office space, like we've talked about. So we're seeing some of it kind of trickle in now, where if something is, gives a property owner the ability to appeal it, or SDAT the ability to do an off-cycle assessment, we're seeing some of that trickle in. But for fiscal 26, all those properties in Group 1 will be reassessed, and we'll see what the impact of that is collectively. So just something to just kind of remember when we're planning for future budget years. Next up is transfer and recordation taxes. What we're seeing here is that we're projecting a deficit of $1.4 million versus the adopted budget. The transactions are down for these sources, 14.5% and 19.7%. Respectively, across those two sources for recordation and transfer. We had anticipated that there would be a decline in transactions. This is actually a little bit worse than what we were anticipating. As we've kind of told the story from the last couple of years, you can see with the charts, 2022 was just a phenomenal year. Over $175 million of transfer and recordation receipts. That was the highest that we've ever recorded. You saw that, you can see in 2023 on the bar chart, that we kind of retained some of that strength in fiscal 2023, and now we're just kind of back down to earth. Our projection is to be at $95.4 million, which is very close to what we were generating. You can see from the chart, kind of pre that big housing boom in 2022. This was expected. You've probably heard us say before, we budget very conservatively for transfer and recordation because we don't want to rely on a one-time increase in revenues and build our budget with operating costs, recurring costs around that. So we've been very conservative there. And this chart, I think, helps explain why we do that, because that number can get up very quickly and come down very rapidly. And here it did over just a 2-year period. It's down by over $80 million. The one piece of good news here is that even though the transactions are down, the sales prices on properties are retaining and actually increasing a little bit in value. So that's a good sign. You can see the average sales price in 2023 in the second quarter was $251,000. This year it's $253,000. So we're getting a little bit more on the sale price, a little bit of improvement there, but it's not enough to offset the decline in transactions. Next up, cable TV franchise fee. So we're projecting a $1.4 million deficit here. And again, the chart tells the story here. We have lost a lot of subscribers, so the revenue from this comes from the franchise fee that is paid by Comcast, and it's based on the number of subscribers. We've lost a lot of cable subscribers, as many states and jurisdictions have over the last couple of years. There is a schedule to renegotiate that franchise agreement that's coming up. I don't recall the exact end date of the agreement, but it is in process that we're renegotiating that agreement. One thing I would say is like, I hate looking at a chart like this and feeling like helpless, like there's nothing we can do, but we know people are shifting away from cable and moving to streaming services. BBMR has looked at other options for how we can combat this as part of our 10-year financial plan. And just for example, at the state level, a few years ago, they expanded the definition of the sales tax to include streaming services. So the state is taxing these services, but because local jurisdictions don't have that authority, there's no way for us to capture revenue through that. There might be other vehicles where you could do like an excise tax or do something through your admissions amusement tax, but there's nothing legal that we know of now, but we're exploring options to combat that because that is a significant loss of revenue that we can't count on now going forward. So that is all the revenue items, again, starting with surpluses and looking at the deficits. I'll jump into expenditures now. So a couple of just high-level points. So our expenditure surplus overall across the general fund as a whole is just $300,000, so basically right at budget. A couple of trends we wanted to point out, our vacancies have declined a little bit from back in November, so they're down from 2,083 to 1,990. That's progress. We've had a lot of trouble filling positions and keeping positions filled, so we're making a little bit of progress on that front. There were 4 agencies at this time. Last year, we're on track to not be within budget. Board of Elections, Health, Liquor Board, and Mayor's Office of Children and Family Success, they're all on track to be in balance. Fire still is the one with the largest projected deficit, which we'll talk about in a moment, mostly driven by overtime. And we are still seeing some posting of grant-related costs into the general fund. This is kind of a vestige of just like the workday transition, and we're trying to get that sorted out. It does distort a little bit our projections sometimes, but we are working to get those charges put in the right account in the system to make sure they get charged to the account. Next, just a little bit more about the agencies that have, or the services that have large vacancies. You can see by service, services where we have 50 or more vacancies. You can see a couple of services in police, in fire, in DOT, in health, and libraries. Citywide, our vacancy rate is still hovering around 20%, which means about 2 out of every 10 positions are still vacant. In terms of agencies that have surpluses, so first we're showing here agencies that have surpluses of greater than 10% of their budget, and I won't read them all off, but you can see we're listing by percent those agencies. Some of the dynamic here, a lot of the dynamic here is these are often some of the agencies that do have high vacancy rates, and if you have high vacancy rates, especially in civilian positions, that you're not backfilling with overtime or contract or other costs, it tends to generate a lot of surplus. So that's true of the first, 4 agencies for sure. Minority and Women's Business Development, Zoning, Comptroller, and Office of Equity and Civil Rights. They're all heavily civilian kind of position dominated. And if you're not filled with all your positions, you'll turn up a big surplus. On the next slide, there's also some other agencies that have surplus within 10%. And again, so this to me is kind of the ideal where you want to be operating. You want to have agencies kind of close to budget and have a little bit of room, but you want to have their positions filled and have them spending everything that's available to them in their operating budget. Next, on the next 2 slides, we'll walk you through some of the agencies that are projecting deficits at this point. I will say for that these agencies are just projecting a deficit as of the second quarter. We're still working with all of these agencies to try to get them back on track. If we were to end a year with a deficit, of course, we would come, later in the year to the council to ask for supplemental appropriation or transfers to try to close these. But just want to give you a little bit of commentary on what's going on in each of these agencies. So for finance, we're projecting a $600,000 deficit, and that's largely because we are still supporting our payroll function via contract rather than our in-house staff now. So we are using a contract to support the payroll function. We're planning to wind that down in fiscal 25. So we're working to get that out. But in the meantime, as part of the workday transition, we've had to spend a little bit more to make sure everything is tight for our weekly payroll runs. Fire department, we mentioned, this is largely due to overtime that's needed because they have such a high vacancy rate. We also are still using a contract for BLS ambulance service that started during the pandemic, and they've been using that to kind of fill gaps and provide service when we can't staff up to full capacity, which has been a challenge because of the high number of vacancies. In law department, there were some position reclassification actions that led to a higher cost in law. The Enoch Pratt Free Library is showing a $300,000 deficit. This is unusual because they usually have a high number of vacancies, and this is one of those areas where some stuff got charged to the library that we think can be reclassed to grants. The Convention Center Hotel, the arrangement here is we're responsible for sending them the value of their property tax and the hotel tax that they generate, that building itself generates. We budget for an estimate of that, and they're actually generating a little bit more hotel tax this year, which means we have to remit that back to them, which is what's driving that $900,000 deficit. That's not any reason for alarm. That just means that their hotel tax is coming in higher than what was expected at budget, and we have to remit that to them. You can see art and culture grants, $800,000 deficit is driven by their OPC cost. We have an arrangement with the museums that we support. We give them a discretionary grant. We also support them for their other personnel costs, and their OPCs are coming in higher than what was budgeted. For MOIT, or BSID, I should say, and cable and communications, they're both exceeding. We expected them to have a certain amount of turnover on their staff, and they're actually exceeding that. It's actually not a bad thing because it means they're actually filling their positions, but it's leaving them very tight and coming in close to budget. Homeless services, we have some grant-related costs that we're trying to figure out that have hit the general fund that we think can go back to grant. And we do know that our shelter contract costs that were committed are a little bit higher than what we anticipated in the budget. The police department is relying on overtime to staff shifts due to the large number of vacancies they have. As we've explained before, the police department right now is generating a lot of salary surplus because they have so many vacancies, and then they have to spend on overtime, and those things are largely netting themselves out. What we've also seen is that we had some unexpected cost in police for arbitration rulings about how we award on-call pay. So some of those have gone against us, which means we've had to pay out a little bit more than expected for some of the penalty pay provisions in our contracts. And then finally, Public Works, a $300,000 deficit, mostly related to contractual expenses to support trash and recycling routes. There are increased tipping fees that we pay to take waste to Bresco as well. But if you remember last year, they ended with a multi-million-dollar deficit. We think they're on better track this year and will come in closer to budget and hopefully at budget by the end of the year. I think that was everything. Yes, it was. So I'm happy to pause here and answer any questions, and we have staff here too that can help answer any questions that you have for us.
Awesome, and thank you for being thorough as always. During the presentation, there were a couple of points where you mentioned like the highway user revenue and other pieces where there could be an impact on the impacting the deficit on the capital side. And so, just want to pause really quickly for the mayor's office. Tyler, I know some may have had the expectation for the capital budget to be presented. Can you talk about just why that hasn't happened? Not just making sure that we're all on the same page and how. And then we'll shift back to BBMR.
Yeah, planning is having some technical difficulties pulling information that would be helpful for this hearing from Workday. So as they work through that, we'll be able to present at a later date. Obviously, if there are specific capital projects that the committee is interested in an update on, if you provide that to me, then I can work to ensure that we can provide that update.
And thank you very much for that, because I think that's just important in terms of the clarity, right? And we want to have the most accurate data available. So I appreciate the fact you didn't want to rush it and make sure that it was accurate. So again, we'll keep that noted. So appreciate that. All right. So now, wow. One of the things that obviously is a challenge, I'm going right back to the transfer and recordation taxes. And we do understand that that's a piece that fluctuates. A related piece is obviously, well, maybe not obviously to everyone, but that's also the funding mechanism for the Affordable Housing Trust Fund. Can you talk a little bit about the impact on that? Because obviously there's a significant challenge there.
Yeah, so the numbers we were showing are just the what I would call the normal or baseline transfer recordation, which all comes to the general fund. What you're referring to, there was also what's called, I think we call it the yield tax, which is that additional charge that goes on transactions that are over $1 million. And those, by law, all go directly into the Affordable Housing Trust Fund. I do know that during those really strong years we had in fiscal 22 and fiscal 23, we generated a lot more high-value transactions, and that put a lot of money into the Affordable Housing Trust Fund. That will presumably cool off now because we've kind of come back to earth, but that did generate a lot of resources. I don't have that in front of me, how much it generated, but I actually remember at the last hearing, I think Councilman Ramos was like, oh, we're getting a lot more in the Affordable Housing Trust Fund because of that volume we saw. But now it's kind of coming back down to normal. And so that tax is levied on just transactions over $1 million. They're hard. It's hard to predict because those transactions are unusual, but it does generate some resources every year. And but there was really a flood of resources going in 22 and into 23, and now back down to normal. So that data we do share back with the trust funds members, but we could gather that and tell you exactly what was generated if you're interested in it. I know Pedro could gather that data and share with you.
That'd be great, because I know others will have that question too. So thank you. That's helpful. And then I have another question. I'm sure Councilman Reporter may have one, but one thing that stuck out to me when you were mentioning about the investment earnings and the ARPA cash, the cash on hand available. Can you just walk us all through that investment process, like what that looks like? Are we talking about now there's more money being invested, and what that looks like over time? Because I know there's a limitation, like you said, based upon the time horizon with ARPA.
Yeah. So our treasury management team, we have an investment policy that's approved, I believe, by our Board of Finance about what we can invest short-term money in. And so we only invest our short-term cash in like very liquid things, maturities less than a year. So things like treasury bills, certificates of deposit, really safe investments. And so that process is as it always has been. We tend to have more cash on hand at the beginning of the fiscal year because we're generating money from the property tax bills going out, and our expenses are a little bit more evenly distributed throughout the year. So we usually have a little bit more cash in the beginning of the year. We put it into short-term instruments, and whatever the proceeds are that we generate is what we count on in the budget for that line item. Because we have ARPA, we had over $600 million of funds, and as you've seen in kind of the reports, they do a really nice report on their website that shows how much money is obligated and spent at any time. The last time I looked at it, it was about a quarter of it was reported spent. All of it had been reported as obligated. So that remaining 3/4 that hasn't been spent, that money gets dumped into the general pool. We invest it like all that other revenue, or all that other money that we usually invest, and we're allowed to keep the proceeds in our general fund. So what you have happening is we have a larger cash balance available now because of ARPA than we typically do, and also the fact that the interest rates are higher than what we had even expected at the time of the budget. Both of those things are what is driving that significant surplus. Now, over time, as we spend the ARPA resources, we'll have less kind of one-time cash available. And then once we get to the end of calendar 26, presumably when there's no more ARPA left, we'll go back to kind of normal. But normal at that point, we'll see what that means if interest rates are still high or low. And I think as we showed on the graph, when interest rates are really low, it's market driven, and we generate almost nothing in investment earnings. One thing that I should mention is that investment earnings and transfer and recordation tend to kind of like move in different directions, because when interest rates are high, it slows down the activity in the housing market, so we get less transfer and recordation. But when interest rates are high, we get more investment earnings. They don't exactly balance each other out, but they're kind of like counter-cyclical, I would say, because when interest rates are higher, there's less transactions in the housing market. But when interest rates are higher, we're actually collecting more because we're a short-term investor of cash proceeds. So those two things tend to sort of balance themselves out. Again, not exactly, but that's the dynamic we're seeing this year when our transfer and recordation receipts have come way down and our investment earnings at the same time have come way up.
No, thank you for making that correlation. Councilman Reporter?
I did have a quick question, sir. I wanted to talk through the second quarter expenditure outlook, particularly the vacancies for school health services. As the blueprint for Maryland comes online, how are we going to deploy those additional school-based health center funds to get more community health workers and nurses into the schools? And you may not be able to answer that question. That may be a question for the mayor's office, but I'm hoping that with the increased funds, that vacancy rate will come significantly down.
Yeah, I can speak to that, what we know. So the dynamic in school health has been, you've pointed out, that's one of the services with by far the largest vacancy rate. What we've experienced over the past few years, I mean, it's really difficult to hire nurses right now. I mean, you've probably read a little bit, there's like a nursing shortage, it's just hard to get those folks. There is additional resources that are going to the schools because of the blueprint funding. Some of that's coming from us, of course, right? Which we talked about, at these hearings ad nauseum. So we're trying to work out an arrangement with the schools where by they pick up some of the cost of some of the schools so that we're not having to kind of bear the burden of supplying nurses for all of the schools. And so we're working on them with that. We don't have like a signed agreement, but we're trying to make sure that since the schools has additional resources, that they can support certain schools and that our health department supports certain schools. So we've been working with them on that. I can't say it's solved. It's still a challenge because regardless of whether we provide the nurses or the schools, it's still hard to hire right now. And so we've been trying to be creative about, well, is there things we can do to kind of incent people working there, be smarter about which nurses support which schools and sharing, schools in some cases. So, but that's the status at the
Thank you for that. One of the, just a flag that a previous program that was started by the health department about 7 years ago, and this is something that I have an upcoming hearing on related to school-based health centers. It was a telehealth medicine perspective where, it was kind of a regional approach. So maybe figuring out, and the new health commissioner was actually the lead for that particular program at the health department 7 years ago. It may be an opportunity to kind of expand or research that program so that we can kind of collapse a lot of these positions, reduce vacancies, but also addressing the public health need for school nurses within the schools.
I'm not familiar with that program in particular, but I'm interested to learn more because, there's probably ways we can be more efficient and
Sure.
maybe, I mean, we say this across a lot of services, like we can't necessarily assume that we can just add bodies to fix problems all the time, right? We have to find more efficient ways to do that. And that sounds like one, good idea of how we could do that.
Yeah, and I will tell you also, Montgomery County and Howard County have verified models, and so this may be an opportunity to replicate what they're doing in other jurisdictions here. Thank you. And there's also state level funding associated with it, so that may be an additional state level funding associated with it. So.
And I'll just say thank you, Councilmember Porter, for raising that point because, again, that's where I think where we should be going towards school-based health clinics. And so having that as a presence of mind is important. So thank you. Another question, and this comes up a lot in terms of some community conversations, but around property taxes. And you had mentioned the appeals process. Can you talk about that a little bit? Because you had mentioned also that on the commercial side, sometimes people are asking for, or entities are asking for off-cycle assessments, but then on the residential side, people are also trying to appeal. So can you talk about that a little bit too?
Sure. So and Pedro, chime in if I get any of this wrong, but basically, our assessments are done on a 3-year cycle. So you get your assessment notice at the generally around the end of the calendar year, and you have an opportunity when you get that assessment notice to appeal it. And so, a lot of people take advantage of that or try to appeal properties, down, obviously down because they want to pay less in taxes. We actually have a unit in finance, the Fiscal Integrity Office, that actually tries to appeal things that we think are too low. So we're kind of looking out for the benefit of the city. And if we see especially larger properties that we think are assessed too low, we'll actually sometimes make a case and go to SDAT, just like a property owner would, to make the opposite case to say, hey, this assessment should be higher. The dynamic that's playing out in the commercial properties is there are some rules by which a property owner can do what we call an off-cycle assessment. So basically, they can go to SDAT and say, hey, can you assess me before the end of my 3-year term? So usually just get it, you get your assessment, then you have to wait 3 years until you get your next one. One of those is if there's a sale of the property, and that was one of the examples we saw there where I think it was the 10 South Street or 1 South Street property. I'm not sure if I'm pointing in the right direction. No, that way, is, sold for much less than it was assessed at. We're assuming that the property owner went and said, hey, it sold for much less, and it triggered an off-cycle assessment where the value came down. The same is true if there's any particular circumstances where like the business environment has changed, which we think is the dynamic on the T Row Price building, for example. So there are rules by which SDAT will trigger, there are things that will trigger SDAT to do an off-cycle assessment, but every homeowner, when they get their reassessment every 3 years, any property owner has the right to appeal if they so wish. And in our projection each year in the budget, we try to account for that. So like if there's a year, like for example, heading into fiscal 25, we know assessments came in really strong, almost 20% growth over 3 years. So we will work with the revenue team. We'll know that, okay, if assessments were that high, we probably have to build in a factor to take that down because we know a lot of people are going to try to appeal their assessment. So we work out those dynamics and those, I would say not dynamics, but those assumptions in our budget each year. But what we're seeing here is that with the downtown especially, some of these issues are triggering off-cycle appeals, which means they're coming down sooner than we would have liked. And like I said earlier, we might see additional kind of downgrades of those properties when that whole group one, gets reassessed for the fiscal 26 budget.
Thank you. And then also, the declining collection rate obviously has its challenges, but at the same time, I'm glad you mentioned the impact that the tax sale is having on it. But I guess my question is, I see that it's going from 95.9, or it's going to 95.9, but lower than the 97.5. Are we seeing that? Do you expect that the rate will continue to decline? Do you think it's going to stabilize at a certain point, given that tax sales are out of the question for owner occupied?
I mean, that's an interesting question. It's hard to say. I think we've now had provisions. I think this is now 4 consecutive years because it goes back to COVID. I think it was either 2020 or 2021 was the first year where we made exceptions to 2020. Okay, so we've done it for 4 years now. The question, and so I have mixed feelings about this, honestly. On the one hand, we want to do everything we can to protect folks, and the actions that the mayor has taken the last couple of years is to say we're going to withhold at the very last minute any people that still can't pay. And there's certain criteria. I think last year it was folks that were residential owner-occupied properties. I think it was under $250,000. So if we have people that can't pay, we certainly don't want to subject them to the tax sale. We want to protect them if we can. What we need to be mindful of is that we don't want to send a signal that you just don't need to pay, right? And so that's why if we've done this now multiple years in a row, we're trying to figure out what impact does that have on our overall collection rate. For most people that have a mortgage, you're paying your taxes through your mortgage, so you might not even know the difference. But for some homeowners that are not paying through a mortgage, could it send a signal that we're not going to collect? I don't think so, but it's something that we have to be mindful of and stay on top of. That we have seen the collection rate in prior years come down. And again, we know that when we're withholding people from the tax sale and saying we're not going to collect, we're losing a little bit of revenue on those properties. And again, the theory here is that we're protecting folks and we're causing less disruption in the community because we don't want anybody to lose their home. But we're trying to weigh the balance of okay, what's the right level to do that? What's the right level of protection to provide without jeopardizing our ability to collect? And you often hear us say non-owner occupied properties or commercial, we don't want to exclude because that's not a homeowner necessarily. Sometimes that's a landlord or somebody that lives outside of the city or whatnot. So we try to go pretty aggressive after those. And then we've tried to build in those protections, that you've seen over the past few years, just making sure we do everything we can to protect the residential owner occupied properties.
Councilman Porter, please.
Yes, and to that point, how many people, as far as the tax sale, how many people do we have working in that office? I was under the impression just recently speaking with an ombudsman that there's only one person working in that office.
Well, there's just one person in HCD is
Yes.
the ombudsman, but the finance department has a whole team of folks in revenue collections who work on tax sale issues. I don't know offhand how many. Most of them are dealing with general collection issues, and some of them get to be more focused. It's at the time of year of tax sale to do a little bit more work. But the ombudsman is just the one in HCD. But
Yes.
revenue collections has the folks that manage the actual processing collections and sending out the final notices and whatnot.
Yes, and the reason why I asked that is because you hit it right on the head in your last sentence. Sending out the notice and making sure that we at least get some sort of connection with the owner well before they approach tax sale. And so there's so many inconsistencies with a person's mailing address, whether they're still there. Like, I'm wondering if there's an opportunity for us to delve into that process a little bit deeper so that we are really kind of filling those holes of those inconsistencies through the process, because at any given time, if one person, I mean, if a portion of that process is missed, then that person, that likelihood that they'll get more and more, more and more kind of closer to the tax sale, and losing their home. So,
Yeah, just a comment to that. I think you're right. Our challenge, just speaking just for finance and our revenue collections, is like they have the work to do just to get the notices out, collect the money, answer the questions on the phone. There is, I think, reason to believe that having people or staff available to kind of reach out to folks and help assist would be beneficial. Today, we rely a lot on a lot of nonprofits or support groups in the community. So, we give information on tax sale at some of the, community centers. I know there's nonprofits that do like legal aid work, because one of the issues that's come up is, titles that aren't in the person's name, or they inherited it from a parent and that they're not on the title and they can't get out of some. So we do have a lot of providers that are out there trying to assist people. I can't say much about how comprehensive that is or if there are gaps there. But the finance people that are supporting it are really kind of more just the transactional, like getting the notices out, collecting the money, answering kind of customer service type questions, but aren't necessarily as skilled or trained to be doing kind of the outreach, which is a whole nother piece of it. But I definitely hear the concern. We're certainly aware of that.
I'd like for that for the mayor's office. Let's as we approach the budget season, let's see how we can expand that a little bit more. Thank you.
And just to, to chime in as well, I know we get a lot of calls, from residents who are, challenged in that regard. So it's a good point. So I think we can collaborate. And I think that's the great thing about hearings like this, where we're getting information and think about how we be proactive. So I appreciate that idea too. Thank you. Oh, one other piece. Do you have another question? Right. Okay. This is not a new issue in terms of fire having challenges, but you mentioned they have the largest projected deficit, personnel and overtime. You already talked about it before, but any additional information you can share, or any potential solutions. I mean, obviously, these are conversations we need to have with the agency as it relates to hiring and personnel. But
Yeah, I would just say, yeah, this is becoming kind of a long-standing issue, and it's going to take years to correct it. I would say there's three kind of primary things in terms of potential solutions that we've been talking about. One is obviously just the recruitment aspect, because it's really hard to hire paramedics and EMTs, especially right now. I think on our list we had showed that those services, EMS and I believe suppression, are two of the services in the budget that have the highest rate of vacancy. So some of it is just purely like the challenge in hiring. We've been talking about how can we better do that in terms of salary structure, or is there ways we can do incentives and things of that sort. One of which there actually is a paramedic incentive, I believe, active right now, that's available. The second thing is, and this is something is subject to negotiation, there could be some things we think we can do to better control leave. If a firefighter or paramedic or anybody calls out sick or has to take leave for any reason, that is what is requiring us to backfill on overtime. So not only don't we have enough people to fill kind of the number we need to staff the full complement of vehicles that we support, but if anybody is off or sick or on vacation, that leads to backfill overtime. One thing that came out of our last contract negotiations is that we are an outlier on how generous we are on sick leave. And so that's something we have been talking about as part of the next round of labor negotiations. Should we have more rules there, or better, tighter rules about how much sick you can use in any given year? So that would be the second thing. And again, that's something that's subject to negotiation. So we'd have to negotiate that either into or out of the contract. The third thing I would say is looking at civilianization. I mean, we've taken pretty aggressive steps in the police department. We've basically said, look, we can't fill all these sworn positions, and to keep making sure that sworn people are doing sworn functions. Are there things that sworn people are doing that a civilian could do? You know, the basics, like things like human resources, finance, and those kind of things. But even other things like the police department kind of tested where they had civilian investigators that help their sworn investigators on cases. We haven't been as aggressive about doing that on fire, frankly, and I think it's a smaller department, but I think there is room to look at and think, like, if we're really desperate for sworn bodies, let's make sure that we don't have any sworn people doing things that could be done by civilians. And could we take a similar track that the police department has taken over the last few years, part of which is kind of enforced by the consent decree. But I think it's a good way of thinking about it, that if we can use civilians to do some of these tasks and jobs, it frees up the limited number of people that we have that are sworn, that go through the academy and are skilled at doing that work, to kind of put them to work in those areas. So those are the three I would say are kind of in my mind, in our office's mind. But it's going to be, I think, a multi-year process to kind of get that back under control, frankly.
No, thanks for walking through that. I know it's complicated and it's not easy to address. Councilman Porter, do you have any additional questions?
I did have one more follow-up question to that, sir. So how are your three recommendations being reflected in this year's budget, this year's upcoming budget?
You mean coming into fiscal 25?
Yes.
Not sure quite yet, because we're
Okay.
actually talking about some of these topics and deliberating over that
Okay,
even now, but there could be something.
great.
in the
Can we
25
make a
budget.
note of that with the mayor's office? Because actually, you educated me today about sworn positions within the fire department, and that's one of the departments that we often hear within our PGSO hearings, that one, they lack the funds for infrastructure, equipment, and things of that nature. So if there's an opportunity to reallocate those funds, let's see how we can do it for the FY25 budget.
Got it, Councilwoman. Just so I'm clear, you want to look at making sure that there aren't sworn personnel doing, oh, yeah.
Oh, no, thank you. So Director Sinema just provided three really great recommendations. One of them of note was making sure that sworn officers within Baltimore City Fire Department are, transitioned into more civilian roles. So we're not making, from my understanding, what you're talking about like a bottleneck within hiring of civilian versus sworn officers?
I was referring more, just to provide some clarity, making sure that we don't have sworn personnel doing jobs that could be
Doing
done by
civilian work,
civilian.
okay.
Yeah, and part of that would be, you have to create a position for a civilian, you have to hire for that person, then once you get that person, there's training, and then you could take the sworn person and say, go back and fill a vacancy
I see.
elsewhere in the department, which we've got dozens of them. So police has done that to some degree, and has taken, some pretty good steps to kind of get there. We haven't seen that same kind of level of change in the fire department. And again, in their defense, like, part of that is driven by the consent decree. The consent decree is telling us, like, we've got to get there on the police side, but we could take the same approach on the fire side.
And I wonder if it can be at the next quarterly PGSO hearing with the fire department. Let's actually ask that as an action item, because I'm not sure what the core competencies are for these positions. And so that would something that Chief Wallace would need to kind of elaborate on, just to make sure that we are still maintaining public safety within the city, but also making sure that we are lean as much as possible within our operations. Thank you.
And thank you, Councilmember, for at least making the attempt to operationalize it, because we have suggestions, and then how do we then work those? Bob?
I was just going to say, like, think of the fire department. I could see a world where, like, inspections can be done by a civilian, maybe rather than a sworn. Investigations can potentially be done. We've kind of done some research. There are some functions. Obviously, like, a firefighter's got to be a sworn person. A paramedic has to be a trained person. But there's other functions in the department where, there are other places that we've looked and researched where that's, there's a reason to believe that civilians could do that work and maybe even do it better, frankly. So those are the types of things we're thinking about.
Well, I believe no one has signed up to testify, and I don't see any questions online. And Councilmember, do you have any more questions? You've done a great job answering the questions that I've had. I'll just say I appreciate you guys being thorough, handling this material. Again, I know will be some more questions down the road, especially given Councilmember Porter's point as we're moving into budget season, right? As we then look at when the rubber hits the road. So again, we appreciate you taking the time today. With that, we will then stand in recess. So have a good rest of the day.
Thank you. Appreciate it.